Okay, thank you so much for having my paper in this great conference. It's a pleasure to be here. I'm Martin Arazi, I work at the Bank of England, so the usual disclaimers apply. So QT, here I don't have to give a lot of details to you, but it's the process of shrinking the size of the balance sheet of the central bank. The motivation of this paper started because at the time when the central bank started to shrink the size of the balance sheet, it was the first time that most of the central banks, except the Fed that did during 2 years before the pandemic, it was for most of them uncharted territory, and there was a lot of uncertainty on how QT works. So that's where this paper steps in to understand the mechanisms under which QT works. Okay, so there was a lot of progress from both theory and an empirical side on how QE works, but QT remained less explored and understood at the moment of implementation by most of the central banks. So some benefits that were cited by the policymakers were in starting this process is that it expands the policy room for future interventions. Some central banks have legal caps on how much assets they can hold in the balance sheets. So in times of calm, it's always good to start a process of decreasing the size of balance sheet to be more active if there is another crisis. Under some situations, it might work as a complement of interest rate hikes. And then there are some distortions or footprints in the financial markets, for example, due to an inverted yield curve or a flattened yield curve, or some lack of collateral due to the large size of balance sheet. So those are the benefits of starting this process. But of course, there are some risks due to the scarcity of liquidity or reserves that might evolve into a credit crunch episode. There were 3 episodes, 2 in the US and 1 in the UK, for example, during QT episodes. Okay. So I will analyze this question through 2 dimensions. First, to understand the mechanisms under which QT works, I will study announcement effects. Here I will ask if we should announce this policy with more anticipation, and if so, what are the drivers that the policymaker has to take into account. Then, for implementation, I will ask if there is a trade-off or understand the difference between the 2 main strategies that the central banks taken, that are sales or passive unwinding. That is a more slow strategy when the coupons expire over time. And then finally, I will close with optimal policy using an approach that has been developed by 3 ECB economists and 1 academic. And here I will ask what's the role of commitment and discretion, and what are the roles of the features of the 2 main assets that are being swapped in QE, that are the stock of reserves and the long-term bonds. So I will show a banking model where the reserves will feature liquidity benefits, and banks will have balance sheet costs. I will model a balance sheet process that will take into account QE and QT announcements in perfect foresight. And then finally, I will solve for optimal policy. Okay. Some of the main results is that announcing QT with more anticipation will be better in terms of macro financial outcomes. Sales will have a short-term stimulation effect due to a sense of short-lived stimulus by the agents, but then, as is a more aggressive strategy, a passive unwinding will lead to a smoother transition. In terms of welfare and volatility, announcing a passive unwinding and surprising agents with a more aggressive strategy at the moment of implementation will be the worst strategy. And then for optimality, I will show that in discretion, when the liquidity of reserves is higher or the need of reserves is higher, and when the maturity of debt is longer, those 3 factors explain why the optimal QT pace should be slower. Okay, so let me skip the literature. I will have a model. It's a general equilibrium model where households will invest in deposits and long-term bonds that will be subject to adjustment cost. The production structure will be standard as in a new Keynesian model. Banks will have elements of the style of Gertler-Kiyotaki models, but I will add a role for the reserves featuring equity benefits and some adjustment cost in portfolios of banks that will be an important driver of slow-moving capital in perfect foresight transitions. And then a government will be standard, it will be a treasury, and a central bank that will manage the interest rate on reserves and the size of the balance sheet. Okay, so I will focus only on banks, as the rest of the model is quite standard. The banks will maximize the expected discounted value of net worth N. They exit with probability 1 minus sigma. This will work like a dividend payout. It's an exogenous probability. And they will invest in 3 assets: in credit to the firms S, in government bonds B, and in reserves M. And they get funding from the deposits that they get from the households and their own net worth. Okay. So bankers will be subject to an upper bound on leverage. And here, in the sense that the franchise value of the bank has to be greater than a fraction of weighted assets. By weighted, I mean that the asset that will increase most the leverage is capital on a one-on-one. We can think as the most illiquid asset. Then on second place is government bonds by a fraction delta L that is lower than 1. And then the stock of reserves do not increase leverage. And the tightness of the constraint, the theta function, is decreasing on reserves over net worth. Okay, so I will explain in the next slide this adjustment. So here I follow, for example, the paper by the R double star of McKinsey and co-authors, some literature also of Onofre. The tightness of the constraint will be decreasing on reserves over net worth. And this feature will by 2 things. One is that even though the stock of reserves is dominated in return by other assets as credit and government bonds, banks are willing to have a positive amount of them in equilibrium to relax the constraint and increase the space that they have in the balance sheets to provide credit to the private sector. And second, I will also be able to have a difference in the short-term rates, being that there will be a difference between the funding cost of the banks, or the interest rate on deposits, and the interest rate on reserves. So during QT, I will be able to model an increase in the funding costs for the banks. And second, to capture the idea of slow-moving capital of the banks and that building an equity buffer is important, I will have an adjustment cost from the banks when they deviate over a steady state ratio of credit over net worth. Okay. Then the central bank will have a Taylor rule, the standard for the interest rate on reserves, and the size of the balance sheet, I will start with an AR1 process. Okay. So how can we think about passive unwinding and active sales in this setup? The return on government bonds will be 1, that is a fixed coupon 1, plus a decaying factor like in Woodford that will measure the maturity on average of debt and the difference in the price of debt. So if the stock of government bonds in hands of the central bank is decreasing at gamma rate, then I will talk about a passive unwinding scenario. And if this is a more aggressive strategy, then that will be of active sales. Okay? Then there are in the paper other scenarios, but I will focus on those 2. Okay, let me skip the calibration. Okay, so for the first result of announcement, what I will do here is that we are in a steady state, and the central bank will start a QT process when we have the vertical lines in quarter 5. Okay? And here I show 2 different timings of announcements. In the black line is when the QT is announced with 1 quarter of anticipation, and in the blue line it's announced with 4 quarters of anticipation. And here I show that due to the financial frictions in the banks' portfolios, then the banks need time to adjust. So announcing this policy for a fixed implementation date is always better in terms, for example, of net worth, credit growth, and the price of capital, for example. Now I will do for implementation the opposite. I will fix the announcement at the beginning, and I will compare a passive unwinding and a sales scenario. So to drive a crisis, I will have a sequence of shocks to the quality of capital of the firms, as in Merton. That will drive the economy to the CLB. The central bank will start a QE process, and then it will proceed with passive unwinding or sales. Okay. So here I'm showing the same set of figures. In the red line, I'm showing a passive unwinding. So in the vertical lines in each of the plots is where the QT process starts. And in the black dashed line is a sales strategy. So if you see in the first part, in the first half, before the QT is implemented, there is a short-term stimulation effect in the dashed lines of sales. And this is because agents know that if the central bank is more aggressive in sales, they have incentives to front-load investment and consumption. So for example, firms know that credit will be more expensive, so they have incentives to invest now, right? To take the credit now. But then after the policy is implemented and due again to the frictions of the banks, if the sales is aggressive enough, then it might create, for example, a credit crunch, a decrease in net worth, a decrease in the price of capital, etc. So what I do then in the paper to compare these policies is to compare them under welfare in consumption equivalent units and under a measure of volatility of the output. I will have the same results, so here I will focus on volatility of the output. Here it will be in relative terms to an OQE scenario that I will normalize to 1. And what's the worst strategy or the closest to an OQ intervention in terms of volatility is an unexpected one-time sell-off, of course, right? So it's a strategy where the central bank claims that it will follow a passive unwinding, but then at the moment of implementation, it surprises agent with a one-time sell-off. And then the strategy that leads to the smallest volatility in the setup is a passive unwinding. So before going to the optimal policy, here starting a QT process has two benefits. One is the announcement effects, as I show. If agents have, so I have in the paper a counterfactual scenario of a permanent reinvestment strategy where the central bank never starts a QT process, and in that scenario, we don't have the good announcement effects in the sense that there is a short-lived stimulus sense for the agents. And also, if we do a permanent reinvestment strategy and we keep a very large size of balance sheet fixed, then the spreads of credit and the term spread starts to get compressed. It might be inverted under some scenarios, and that might damage eventually the net worth of the banks. That will increase leverage and that will decrease credit in the transition in the medium run. Okay. So finally, now that we have the announcement and implementation effects, that is the two main mechanisms of the model, I will close with optimal policy. Here I will follow closely a paper of De Groot, Maselis, Moto, and Ristiniemi, in the sense that I will have an optimal counterfactual. Okay, so for a counterfactual, we'll need a baseline scenario that I will take the forecast in the Green Book at the time of the financial crisis by the Fed. Okay, so that's the first element as a counterfactual of not starting a QE policy, for example. Then the second element is IRF of the model that I show, and then finally a loss function that will be quite standard. Okay. So here I'm showing three lines. The black line is the baseline scenario. So that is in the Green Book. Then the blue line is commitment, and the red line is discretion. Of course, in commitment, there's a rapid recovery in inflation, a little bit more in output gap. But let me focus to close in this last minute on the optimal QT pace. I will zoom in. Okay? So here I have 4 scenarios. The black one is commitment, that due to the power of forward guidance or the interest rate being more effective in commitment rather than in discretion, in commitment we can be more aggressive and use less the size of the balance sheet. So that's the black line. Okay? Then the blue line, that's in the middle, is discretion, where the planner uses more the size of the balance sheet and is more cautious during the unwinding. In the red one is discretion, where I increase the need of research by the banks or how sensitive it is to the tightness of the constraint, where the central bank has a higher size of balance sheet and is more cautious during the unwinding. And then finally, in the light blue line is discretion, where I decrease the maturity of debt. So I show that if I decrease the maturity of debt, shocks are less amplified. So that makes that the central bank can be, on the first 3 years, more aggressive, 7% more aggressive. Okay? So I will close the presentation. So announcing QT with more anticipation is always better in terms of macro outcomes. Sales have a short-term stimulation, but then a passive unwinding leads to a smoother transition. And then the optimal QT pace is slower when the planner has discretion, when the maturity of debt is longer, and when banks need more stock of reserves. Okay, so that's all.
Thank you, Martin. Okay, we started slightly out, so I'll take one question from Wolfgang.
Very interesting. Do you have any message for if we ever to set on QE again? Is it the same thing in reverse? What's the optimal way to implement QE?
Yes, so here for that I have an asymmetry that there are two sources of asymmetry here. One is that the state dependency, if we are at the CLB or not, of course, the multipliers, and then due to this tightness of the constraint is nonlinear. So what I buy from this is that if we do QE or QT when there are lots of reserves, if we go from 26% of GDP to 25, then it will have a small effect. But if we go from 7 to 6, then it will have a huge effect. What I have here is that ex ante is always better to have a passive unwinding to start a process. But then if in the middle of the transition there's another crisis, then ex post is always better to do sales, because with sales we have more space in the size of balance sheet of the central bank, so the QE can be more aggressive if we started a more aggressive strategy in the period before the crisis. Okay? But so the way I model is an unexpected crisis in the middle of the transition.